Your home buyer found his or her home. They love it. Your job is done, right? That's not really the case. Rather, this is still the process of making sure the home is approved for the loan. That's not a done deal just yet, even after your home buyers have been approved for a loan. The underwriting process can be a complex one, but one that's mostly hands-off for the real estate agent. Now, you need to wait to hear back from the lender about the status of the loan. What's happening? What's taking so long? Whether you are representing the buyer or the seller in this transaction, they will be asking questions throughout it. Generally speaking, it can be a long process, but it is one there's little you can do to help along. So, what actually happens during underwriting, and what is it anyway? Large specialist financial institutions handle the underwriting process. This includes the home buyer's lender. The underwriter guarantees the payment to the buyer for the home and takes on the financial risk of taking on that loan. Before they will do that, financial lenders must make sure that the mortgage application received passes the requirements to obtain the loan based on the home presented to purchase. In short, the lender looks over the borrower's financial profile and makes sure that it matches the loan criteria set by the lender. The underwriter ends up making the decision about whether or not to approve or deny a request for a home loan. What are they looking for? More specifically, we need to examine what the criteria is for the underwriter to complete the process and approve the loan. There are several things to consider here. Specifically, the underwriter is reviewing the capacity of the buyer, the credit of that buyer, and the collateral itself. Let's explain. First, the underwriter looks at the capacity of the borrower. Does this person have the financial resources and the means to pay off any debts? To know this, they take a very close look at the individual's employment records. They look at income and debt. They look at all assets owned. The debt-to-income ratio is considered. This is the percentage of the homebuyer's debt compared to the amount of income he or she is bringing in. Generally, this will not exceed 30%, but it differs from one lender to the next. All information regarding assets, such as checking and savings accounts, retirement accounts, or others, are verified. The homebuyer should expect that the underwriter will verify every detail. He or she will not only use paycheck stubs, for example, but will call the employer to get a verbal confirmation. Debts matter as well. The lender will look at principal, interest, taxes, and insurance, or PITI. This refers specifically to the various components of each mortgage payment the borrower makes. The principal is the amount of each loan payment that goes to pay down the existing balance, amount borrowed, by the lender. The interest is the amount of each payment that will go towards paying the interest on the loan. Taxes and insurance are additional concerns. The underwriter wants to ensure that these costs, whether a part of escrow or not, are affordable to the borrower. If the borrower's debts are too high to make these payments comfortably, the underwriting process will not go forward. Next, there's credit. Does the home buyer have a solid repayment history on his or her credit. This information tells the underwriter whether or not the individual is likely to make payments going forward. The credit report of the individual is pulled, a new version that provides an updated look at repayment history, the amount of debt, and the credit actions the individual has taken. The debt-to-credit ratio helps to determine how much debt the individual has compared to how much credit is available to him or her. Those who have a higher debt-to-income ratio are likely to struggle to make their mortgage payments each month. Each lender sets their specific terms for what qualifies for a loan, but generally, a debt-to-credit ratio should not be more than 43%. This is the highest ratio many lenders will approve prior to moving forward with the loan. And there's collateral. Here, the underwriter must ensure that the value of the property being purchased is high enough to cover the value of the loan. This is where some real estate agents may find themselves facing concerns. If for some reason the appraisal of the home doesn't go well, or there are questions about condition, the underwriter can halt the buying process to inquire. He or she can also stop the process fully. That's why home inspections and appraisals are so valuable here. The underwriter will use a debt service coverage ratio to determine if the home's value is high enough to protect the lender should the homebuyer default. It must be high enough on its own to secure the loan. The underwriter also wants to know what the homebuyer's plans are for the purchase. For example, does the homebuyer plan to live in the home? This is clarified under the occupancy of mortgage application. If the home is being sold to someone who will occupy or live at the property, that's seen as a positive, and it also means that the lender can approve the borrower for a potentially lower rate compared to if the home was being purchased for rental income. Now, it's important to consider how all of this impacts the interest the homebuyer will pay. As we've discussed, lenders select an interest rate to assign to the homebuyer based on the amount of risk he or she presents to the lender. At the time of securing the pre-approval for the mortgage, the lender will offer an interest rate based on the criteria provided about the individual's financial situation, including his or her credit report. However, if the conditions of the loan have changed, or the borrower's credit qualifications have changed, the lender can make changes to the interest rate. This can happen during the underwriting process. For example, let's say your homebuyer found his home, fell in love with it, and won the bid on the property. That's great, and the loan is moving forward. They are so confident that they take out a few new loans to purchase furniture and other items for their new home. Or, the worst happens. They lose their job. They still think they can afford the loan because the buyer is sure to find a job. When these factors occur, the underwriter can require that the credit qualifications of the homebuyer be reconsidered. This can throw the loan back to the mortgage broker, or it may be outright denied. That's a harsh reality many homebuyers have no idea can happen. It's often wise to make sure your homebuyer knows that they shouldn't do anything that could alter their credit report, income, or debts during the underwriting process. The interest rate provided by the lender is ultimately tied directly to the amount of risk the borrower presents in the current circumstances. There are some factors that the lender cannot consider when providing a loan. There are numerous laws that prohibit the lender to make credit decisions based on discriminatory factors. There are two main considerations: the Equal Credit Opportunity Act and the Fair Housing Act. The Equal Credit Opportunity Act forbids lending decisions to be made based on race, color, religion, sex, marital status, a person's age, national origin, or whether or not they receive any type of public assistance. The second law, the Fair Housing Act, places specific restrictions on making loans to buy, build, repair, or otherwise improve a place to live, selling or renting a place to live, selling, brokering, or appraising a residential property. It also forbids discrimination based on race, color, religion, sex, national origin, familial status, or handicaps. These are called protected classes. Additionally, other state and federal laws limit the lender's ability to make decisions for these loans based on the neighborhood in which the property is located in, if it has high crime rates or a certain demographic, as well as discrimination from the source of income. Keeping all of this in mind, what is the job of the real estate agent? First and foremost, you'll need to be able to explain to your homebuyer what actually is happening during the underwriting process. There are situations where the underwriter may be able to connect directly to you, the agent. If there are questions about specifics related to the property, its title, or other property-related concerns, the lender may wish to gain clarification through the real estate agent. Generally, this only happens when the homebuyer has given permission for the interaction. The underwriting process can take a few weeks up to a few months. It is much longer for short sales and foreclosure-related properties than for traditional loans. Nevertheless, you will need to keep your clients calm throughout this waiting process.